Good evening, everyone. Can everyone hear me? There's a way for you to, because all of you are on mute, but there's a way for you to send me a note. So if you can hear me, just send me a note and tell me you can hear me. Okay, so this is your review. So you need to tell me, and you may have to unmute yourselves. Tell me what it is that you want me to go over. Because that's what I'm going to focus on. So if you have something in particular that you want to go over, let me know and I will do so. Right now we only have 7 people online. So just go ahead. You can either type me your question or you can. Okay, so Sarah is in a loud place, so she didn't want to turn her audio on. But Sarah, if you have a question, and someone else is in a loud place too. So if you have a question, just type it in and I will go over that. Because there's no agenda on this. This is really you wanting to me to have to clarify something. Okay. And I know some of you are probably online because you just want to hear the questions other people have. So the floor is open. Who has a question? Who wants me to go over something in particular? By the way, I think this is being recorded. Yes, it is being recorded. So you probably heard that on when we started the session. So I will clean it up from all the stuff I just said at the beginning. So you can ask as many questions as you want. So go ahead, go for it. Who has a question? Don't be shy. I think some of you have been having some questions on the statement of cash flows. So we can go over the statement of cash flows questions. These are the ones that we did in class. The quizzes, I can't go over the responses to the quizzes because those are quiz closes tonight, so I really can't go over any of those. But I can pull up a sample question and let me see. We can go to the sample quizzes and we can look at some of those questions. Okay, so let's see. I think we did some of these in class. Let's see if there's any different ones here. Well, here's one. I think some of you have had questions like this. Okay, so there was a question about average daily rate. Let's go over this cash flow question first. Some of you emailed me because you had questions on some of on the statement of cash flow. So some of the questions you might get on the exam are not about a particular section of the statement of cash flows, like what's in the operating or what's in the investing or financing, but basically it could be like one of these questions right here, which says you have 4 items, and then the question says what would be the effect of these transactions on the operating section of the statement of cash flows. Or I think there was a question on one of the quizzes which said, which of the following would decrease, would be an outflow of cash? And it didn't really say what statement it was or what section of the statement was on. So just make sure that you remember all of those pieces that I told you. In the operating section, remember that net income is not going to be an addition or subtraction, but all the things that you adjust net income by. If depreciation were on a question that said what would be showing an inflow of cash, depreciation really isn't an inflow of cash, but it's added back to the operating section. A gain or a loss, again, is not an inflow or outflow, but they're either added or subtracted. But more inflows and outflows are really cash going in and out. So any question you see like that is probably going to be something dealing with a current asset, current liability, or long-term asset, long-term liability, whether or not you receive money. So in this question is asking, what would be the effect of the transactions on the operating section of the statement of cash flows? So first of all, receivables, a decrease in a current asset is going to be an addition. So you know 5,005 is going to be a plus. The decrease in cash you need to ignore, because remember, the whole purpose of the statement of cash flows is to tie back to cash, right? So you're going to totally ignore that item. And then a decrease in notes payable, that's not part of the operating section. Remember, notes payable deal with financing, so you're going to not even deal with that. So then increase in accounts payable, that's a current liability. So when a current liability goes up, you add it. So you have 2 items that would be additions. So your answer would be 15,006, a source of cash. So the key to answering any of these questions is just remembering the 3 sections, and really the first section is the one that will cause you more analysis, because of the fact that you have to remember that if a current asset goes up, you deduct it. If it goes down, you add it. But if it's strictly in the investing and financing sections, just remember that you have to ask yourself, did I receive money? Did I pay out money? That's all you have to remember. Okay. Now, there's a question on ADR, on average daily rate. So let me just pull up an Excel file, a blank one, and we'll calculate average daily rate. Okay. So the question is on average daily rate, which is ADR. Okay, and the average daily rate, again, one of the things I told you in class is that these ratios somewhat define themselves, okay? So the average daily rate is the average price you receive for the rooms that you sold. So if room revenue is $10,000 and rooms sold is 250 rooms, average daily rate is the revenue divided by the rooms, or $40. Okay. Now, in some of the problems on some of the quizzes, it gave you a percentage. It said if total hotel revenue, let's say $1 million. Okay. Let me format that. Let's say total hotel revenue was $1 million. And the problem says room revenue was 70% of total, 70% of total revenue. It's making you think of that mix of sales. So if the problem says hotel revenue was $1 million and room revenue was 70%, the first thing you have to do is multiply the million by 70%, and that's how much your room revenue is. Okay? And if it told you that you sold, we're going to say 1,200 rooms. Okay, you sold 1,200 rooms. What is the average daily rate? You would divide the 700,000 by the 1,200 rooms, and your average rate would be $583.33. Okay, so average daily rate is the average price that you were able to get for every room that you sold. Okay, let me look here on our chat to see if anybody has any questions. So let's see here. The question is, so for group ADR and transient ADR, we're dividing that by the total revenue or group revenue and transit revenue. Okay, well, let's think about that. If you want to know the average daily rate for transient business, then you would divide like things, right? So when you think about this, and you're not the first one to ask a question, but when you think about this, think about what it is you're trying to figure out. You're trying to figure out what average price you receive from a type of business. So you would take that type of business and divide it by the volume of that type of business. The same thing would go for average food check. If you wanted to know what the average food check was for banquets, you would take banquet food revenue over banquet guests. Okay. If you wanted to know breakfast banquet revenue, you would take breakfast banquet breakfast banquet check. You would take breakfast banquet, I can't talk tonight, breakfast banquet revenue over breakfast banquet guest. So whenever you want to find the ADR, the average check for a specific segment, you always take the revenue of that segment and you divide it by the volume of that segment. Does that answer your question? What other questions do you have? Don't be shy. Okay, so the comment is that, and all of you can probably read this, but the comment is that you're a little worried because the numbers seem similar, and that's okay. You know, if you did the calculation correctly, don't worry that the numbers are similar. Worry about the fact that you calculated right. And I think this is one of those things where it's difficult because you think things are going to be so way off, and it may not be that way off. Okay, and that just comes with experience. As you do this more and more, then you'll get a better sense. Okay, but if you're doing what you just said, that you're dividing the revenue for transient over the rooms that are transient, and you're getting the number, as long as your formula is right, don't worry that the numbers are similar. More will come as you analyze it. And the analysis we didn't break it down by group and transient. We did total rate when you're comparing it to some of those other standards. But that's why we do analysis, so that we can see if there's something weird. And if the rates are so similar, it must mean that we're not charging a differential between group and transient, which could be a problem. It could mean that we're not really having a strategy that makes sense for us, okay? If they're that similar. Or it could be a demand issue where they're that similar because the demand in the two segments and the competition we have is not allowing us to charge that much more of a premium for one or the other. I hope that makes sense. What other questions do you have? Anybody? Don't be shy. Debt to equity ratios. Okay, so what question do you have on the debt to equity ratios in particular? What is it that you don't understand? Go back to the, let's go back to the PowerPoints for, let's see what happened here. Let's check close that. Okay, so the comment is, I just was confused because of the project I asked for both separately. Okay, so there are two ratios. Let's go to this slide right here. So you have the debt to equity ratio, and then you have an equity ratio and a debt ratio. So they're actually three separate ratios. So I can see why you're a little confused, but they're different, okay? So the debt to equity ratio is saying, okay, how much debt do I have? And debt is all of your liabilities. Because liabilities are monies that we owe to everyone that we've, you know, whoever we said we're going to pay you back, okay? So total liabilities is all of our debt, whether it's short-term or long-term. And equity is what investors have given us. We've given them in exchange a piece of our business, okay, a piece of the ownership of the company. The other piece in equity is our retained earnings, the earnings that we kept and we reinvested in the business, the ones we didn't share as dividends, okay? So the debt to equity ratio is basically showing how much of the financing is coming from creditors and investors. So it's saying what is the ratio between the two, okay? So the higher the ratio, then the more leverage you are, the more debt you have. The equity ratio is showing how much the company is leveraged, like it says here, with debt. So remember we talked about equity. We talked about equity being when people invest in us and when we keep our own earnings and reinvest them in the business. So what this equity ratio is saying, if it's high, it means that a lot of our assets have been financed through people investing in us or us reinvesting our profits in the business, which we said was a better way of financing our assets than if we took on more debt. So the debt ratio looks at just liabilities over assets, total liabilities. So if that ratio is really high, then it shows that most of our assets are owned by creditors. So when one of the things someone in class commented, and I think it was both classes, commented on was that when we were looking at the statement of cash flows and we were looking at that financing section, and it showed that we had a lot of cash inflow from financing, someone pointed out that even though it was high, a lot of it was through selling stock, which is equity. So even though it was high, it wasn't as bad had it been all from loans. So equity financing, as I think we spoke of in class, and when you do your finance class, you're going to talk more about this and you're going to really analyze this, but it's important for you to know where you're getting the numbers. So when you finance through equity, it's less risky to a certain degree because your investors are not expecting a monthly payment. You're not having to pay interest to them. They're usually in it for the long term or whatever stated period of time you agreed that you were going to give them a return. So sometimes you get equity partners that are in it for, say, 5 years, and then you have to buy them out. But you have 5 years in which to figure out how you're going to buy them out. Versus if you borrow money from a bank, every month you have to make a note payment. You have to have that cash. And not only that, but you also have to pay the interest. So there's a little bit of difference between the two. So that's what the ratio is. So there's actually 3 ratios, and when you're analyzing them and seeing what they mean, I highly encourage you to go through the PowerPoints because I tell you on here what's good and what's bad. So when you go through them, just go through and read kind of what I mentioned and look at the ratio you got, and that way you can explain it. And I see you said, oh, okay, so I think it's making a little sense now. Any other questions that you might have? Okay, so the question is, I'm a little confused on how to calculate select info with horizontal vertical analysis. I know how to do it on the summary and balance sheet, but I feel like I'm doing it wrong with the select. You're talking about on the problem? Yes, okay. So on the problem, I gave you a lot of different pieces of information. So again, some of the information, when you're doing the vertical analysis, it's really more the vertical than the horizontal, correct? Because the horizontal is the same no matter what you do. So on the vertical side, I gave you some statistics. When you're doing a vertical analysis of the statistics, think of that as one pie. In other words, you're going to do the vertical analysis, and your base that you base the vertical on is only going to be the statistics. You're not going to use revenue figures, because that's going to give you something that makes absolutely no sense. Okay, so when you're doing the problem, ratios, the vertical analysis on statistics is strictly, you keep the statistics as one little unit. I think the other piece that I gave you was in the food and beverage side. I broke down the food revenue, but I also gave you food and beverage. So when you're doing the vertical analysis of, say, the expenses, the food costs and all of that, you need to look at, for food costs and beverage costs, you need to go back and look at your, let's go back and look at the income statement. And if you go to the PowerPoints on the ratios, let's see here. Let's look at the ratios. Even though you're doing a vertical analysis, when you're calculating the food cost and the beverage cost on the financial statements, find it here. Let's find food cost. I believe it's going to be here on our operating. There we go. When you're doing the food costs and beverage costs in the food and beverage section, you still need to abide by this. The food cost over the food revenue, or the beverage cost over the beverage revenue. Even though there's a bunch of numbers and the cost in the extra information I gave you, you're still needing to make sure that you're dividing by the right number. So when you see food costs on that additional information, you're going to divide the food cost over the food revenue. And if it's beverage, the beverage cost over the beverage revenue. Your essence, you're doing the ratio twice, because you're doing it in the vertical analysis, but you're also doing it in the ratios. Does that help a little bit, Sarah? Okay, great, great. What other questions do you have? No problem. Okay, don't be shy. Don't worry, I'm not going to think that you're not paying attention in class. Sometimes it takes a little bit of questions to understand it, so don't worry about it. Especially, you may understand it when I explain it in class, and then when you're sitting there doing the problem, sometimes it doesn't make sense. So you just need to ask the question. Okay. What do you expect from the charts? So what I'm expecting from the charts, so let's go to the problem. Let's talk about the charts. And, well, actually, in the announcements, I have some charts, don't I? Let's look there. Okay, so let's look at this chart. And let's talk about what I'm expecting. So in this chart, I sent you this announcement to make sure that you didn't put percentages here like you did up here, that you actually put the occupancy percentage and the average daily rate, because your schedule actually shows that, right? So what I want to do here, and some of you, I didn't ask you for the average number of rooms in the hotel in this chart, but you can use that as a way to answer the questions. What I am really looking at is that you are able to read the results of your operation and be able to look at different ways of comparing your information in different ways. So for example, if your hotel is an urban hotel, you would expect your results to be somewhat similar. If they're not, then what is it that I'm not doing that other urban hotels are doing? Now, these are urban hotels all over the United States. So again, Houston, say, would be different than New York, even though they're urban. The rate might be higher, the occupancy might be higher. But remember, when we're looking at ratio to sales, we're looking at proportions. So, because that's their vertical analysis. So you're looking at proportions. So the dollars don't necessarily have to be the same. It's what proportion am I spending compared to other people that are similar to me. So the West South Central region are going to be hotels that are in locations similar to you. So the economies should be similar. So a hotel that's in, say, Texas or Arkansas or Oklahoma, whatever the West South Central region is, the pricing and the cost structure will be different than, say, an urban hotel that might be in New York. Okay, so but urban and upper scale, all of these, it's all of those hotels all over the US. So what we're trying to do is look at this and say, how am I performing differently? So if your percentage of room revenue, the Cougar Hotel, let's say you come up with 70%. And the other hotels are showing 75, 80, 85%. Then what it's saying is that you as a Cougar Hotel are not generating as much revenue as other hotels that are similar to you. And rooms revenue in a hotel is the most profitable of the businesses because it has lower cost structure than, say, food and beverage. So if your percentage of room revenue as a percentage of all your revenue is less, then you're not going to be financially doing as well as the other hotels. So the question would be, is it occupancy? Is it rate? Okay, so is my occupancy lower? Is my rate not high enough? So you could look at that, and that could help you explain why your room revenue isn't as high. Food and beverage department expenses was one of the other costs I gave you. So if the Cougar Hotel is, say, has a food and beverage department expense cost of 60%, and all the other hotels are less than that, then you have a cost problem. And the cost problem could be mismanagement. It could be that your restaurant is different. Maybe you have a fine dining restaurant as opposed to a buffet restaurant, but definitely there's a problem with your hotel if your expenses as a percentage of all the revenues or food and beverage revenue is higher than the other hotels. So the point of this exercise is for you to be able to look at your performance and be able to compare it to others and know what types of things you would need to go look at so that you can maybe improve your performance. And looking at just these few things is not going to necessarily answer all your questions, but I gave you some other schedules where I broke down some food and beverage things like costs, like labor. That might help you further define whether or not your hotel, where the problem might be for your hotel. Okay, so when you start working, you're going to have a lot of comparisons of your performance in your hotel to your competition or to other information that your owner may find, or against other hotels within the same company. And you have to be able to look at your performance, look at what others are doing, and be able to say, okay, I need to look at this one. This one is a big one. This food and beverage department expense is a big one. I need to dig into that and figure out what's going on. Why am I not as profitable as everybody else? Does that help answer kind of what I'm looking for? And what I want you to do is not come up with weird stories, but just give me an idea of what things you think might be causing you to be different than others. Where might you begin your investigation? And know that you can see that there's an issue between you and the other hotels. Does that answer your question? I hope yes. What other questions do you have? You're welcome. What other questions do you have? I do find that this exercise with the ratios and having you compare it to the STR report is really going to help you as you start working, because all of you are going to have to do critiques of your departments, whatever area you're responsible for, and at least this will help you understand what to, a little tiny piece, understand what to try to do. What else? What other questions do you have? I'm going to pick on some of you. Brody, do you have any questions? I see you're online. Or Pedro, do you have any questions? AR turnover. Okay, so let's look at AR turnover. What specifically is your question on AR turnover? Trying to find my PowerPoint here, because it's one of the balance sheet ones. So with accounts receivable turnover, with your problem, you can only do 1 year, because remember, you need to do that average accounts receivable, which means you're going to take the beginning and ending and divide it by 2 over total revenue. So you're going to have to calculate that first before you can calculate the number of days of your receivables. Let's see, I'm having a problem here. No, I'm not able to. There we go. Look at your chat. At the answer, when it says times, what does that mean? Okay, so what it's saying is, with the turnover, I'll find the right slide here. It's basically saying the number, I guess this is the right one. It's just showing the number of times that, so your total revenue is 11.76 times the average receivables. It's comparing the amount of money that you're billing out compared to your total revenue. Remember in class I mentioned that total revenue is not the best indicator. It should really be credit sales, the sales that you do on, or the revenue that's on credit. But because when you're looking at these ratios or trying to calculate these ratios, you don't have that detailed information. You typically just have like total revenue. So you need this, because this is saying how many times or what percentage of the revenue the receivables is. And so it's telling you how many times on average that is. So once you have that number, then you can calculate, once you have that receivable turnover number, then you can calculate the number of days it takes you to collect something. Okay, So that's just telling you how fast something is converting. And then if you want to translate that into days, then you divide it by 365 or the time period you're looking at to see how long it's taking you to collect something. Okay, which again, I think I mentioned in class that that turnover ratio is kind of not an easy one to understand intuitively, but when you figure out the average collection period, then that makes a lot more sense. Because if I told you it's taking you 31 days to collect your credit sales or the things that you bill out, it makes a lot more sense than if I told you it's 11.76 times of your revenue. So I hope that helps you understand that. But you have to calculate one before you can calculate the other. And I think in your problem, I asked you to do the average collection period and not, I asked you to explain that, not the turnover. So that's what you need to explain to me, the number of days. What does that mean? And don't be afraid if the number looks a little odd. Just make sure you can explain to me that whatever the number is, that's how long on average it takes you to collect something that you bill out. Does that help a little bit? Okay, good. What other questions do you guys have? Oh, good. Oh, maybe we should have class like this every day. No, I'm just joking. We could all come to class in our pajamas. No one would know. I will delete that from the video, by the way. What other questions do you have? Who else is still on the line? Okay, what's your next question? Okay, no worries. Ask away. If I don't understand, I'll ask you to clarify. Okay. Oh, Pedro has a question. Yay, Pedro. Okay, so EBITDA, let me pull up this blank Excel sheet. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So EBITDA. So what EBITDA, what does it really show? So we had EBITDA in our financial statements, we had EBITDA, and we had EBITDA before replacement reserve, okay? So once you have EBITDA, the earnings before taxes, depreciation, amortization, the next thing you do is you actually deduct interest, taxes, and these are income taxes, by the way, federal income taxes. And you deduct depreciation. And you deduct amortization. So we didn't go this far. We stopped here. So then you have net income. And net income is the final number. You're not going to deduct anything more from there. That is it. That is the bottom line. So the reason why most people focus on EBITDA is that interest is the money that you owe, or the interest you owe when you borrow money, right? So if Pedro, for example, has some kind of unique financing opportunity where he's going to pay a lower interest rate than I am, my net income is going to be significantly lower than Pedro's. If Pedro is in a location where, let's say, or a situation where his federal income tax liability, or what he owes for federal income taxes, is significantly less than mine, then he's going to have a higher net income than I am. If Pedro has a lot of assets or chooses a depreciation method that is much more aggressive, where he depreciates things at a higher rate, and there's different depreciation methods, Well, let's say he uses very aggressive ones. He's going to have a lower net income. If I use one that's like, say, straight line, then my income may be higher. If he's got a lot of intangible assets that he's amortizing and I have none, his net income might be lower and mine might be higher. So all of these things, these two here, are based on accounting practices. So if Pedro's accounting practices are different than mine, his depreciation and amortization are going to be different than mine. If his tax situation is different than mine, he may have a higher net income than me because of his tax situation versus mine. And it could be because of the type of company I am or based on my location. Okay, so maybe I'm in Texas where I have no state income tax on a company, and Pedro is in a state that has multiple types of income taxes, not only federal but state. Maybe Pedro has no debt and I have a lot, so my interest expense is going to be higher. So when I'm trying to compare his business to mine, let's say I'm an investor and I want to invest and I'm comparing Pedro's business to mine, if I go all the way to net income, I may make a decision that does not make a whole lot of sense because of accounting methodology, taxing favorability based on location, or debt structure. Whereas if I just focus on EBITDA, I'm going to look at things that are pretty much going to be apples to apples. So investors, creditors, and other individuals typically look at EBITDA more so because it excludes those items that are not necessarily going to be equal among different entities. So does that help, Heather? Does that make sense on EBITDA? Okay, what other questions did you figure out? Oh, great, Heather. I'm glad you got it. Hope everybody else did too. And okay, thanks for the time to finish our project in this loudcast. Okay. Okay. Who else has a question? We still have about 15 minutes. You guys are asking good questions. And remember, we still have, for those of you who are in the Monday class, we have time tomorrow. And for those in the Tuesday, Thursday, we have time Tuesday to go over anything you might have questions on. And I will put an announcement today that the project is not due till Tuesday night, because I think right now it still says Monday. And I think I told everyone in class I'd like you turn it on Tuesday night. And I would put the solutions up Wednesday morning at 12:01. Any other questions? The question for Brody is, would you recommend studying the practice exam or on the problem we have done? I think you do both. You knew I was going to say that, right? You do both. And what I'll try to do is on the practice exam, I'll put a couple more cash flow problems and ratio problems so that you can practice a few more. The other thing, Brody, that I would do is tonight, the last quiz is done. So I would go through and review the quizzes, because the questions that you'll get will be very similar to the quizzes. So go back and review the quizzes. And you can see the solutions to the quizzes by going on my grades and then clicking on the quiz, clicking on the grade, and you can see all of your attempts. So I would study that, and I think it'll be fine. But if the thing that's stressing you out more is the ratios, and then if you did the problem and you worked the problem as a group, but you did it all of you together, you had to write the ratio formula and you had to calculate it 2 times. So Hopefully that will help you to remember the ratios. Remember, I have the checklist, so just go through the checklist, and if you know it, just check it off, and if you don't, then ask more questions about the items that you don't quite get. You're welcome, Brody. Any other questions? Okay. Well, it doesn't sound like you guys have any more questions. Give you a few more minutes to think. If not, then we'll sign off, and I'll post for you to listen to later. I do appreciate that several of you showed up. Sometimes it's just me and one person, so I do appreciate that. Okay. Well, going once. Any more questions? Okay. Well, if you think of something between now and tomorrow, make sure you ask it in class. And if not, feel free to email me any questions you have, either on the problem or on the exam. I think you'll be fine. Again, if you did the problem, you've been coming to class, you go through that review guide and you go back to your quizzes, you should be in good shape. Okay, so Alondra does have one question. What do we do with gains or losses from the sale of a long-term asset? So I think you need to go back to one of our PowerPoints on the statement of cash flows. So if you go to highly recommend, that you go to module 4, the statement of cash flows. Computer's a little slow. And I would go to, you can listen to my recording, but I would also go to the operating section because I explain that there. It's taking a second here. I'm not sure why it's taking so long. It's done. Apologize for that. Slow internet tonight, I guess. There we go. Oh. Let's see. Oh, maybe it's Blackboard that's the problem. Okay. Well, let me just, something's going on here with Blackboard, I think. Try this again. Says I can't download this. Okay. Try one more time. Okay, it's taking too long to load. So let me just pull up my Excel sheet. So in the operating section of the statement of cash flows, you start with net income. You always add back non-cash expenses, which is depreciation and amortization. So these are things that are expenses on the income statement but are not cash. Let me just have to do this. And then if you have any gains, you have to subtract those gains from net income. Why? Because gains are like revenues, and that would make net income bigger. And gains are when we're selling long-term assets, that type of activity goes in the investing section. If we have a loss, we add the loss on the sale of a long-term asset back to net income, because losses are like expenses, which would make net income smaller. And long-term assets, anything related to a long-term asset, would be in the investing section. And then we look at the changes in current assets. And if a current asset increases, we deduct that increase from net income. If a current asset decreases, we add it. So an example of that would be accounts receivable. If accounts receivable goes up, that means we sold a lot of things on credit. So net income would go up, the cash would not. But when someone pays us what they owe us, the current asset goes down, but it's not reflected in here because it was something we sold in the past. So we would add the decrease to show that, remember, the goal is to get net income to equal cash from an operating function. When a current liability goes up, we add it because we incurred a cost. We incurred a cost, but we didn't pay for it. So net income would be less because we incurred an expense, but we didn't pay for it. So we add that back so that, again, we can tie net income back to an operating cash number. When a current liability goes down, we deduct that because we paid for, spell that right? We paid for something, but it doesn't show in net income. And remember, the whole goal is to get net income to equal cash from operating activities, either a source or use. So if this number, if we take net income and we apply all of these changes, I'm just putting stuff here, pretend those are numbers. when we apply all of these changes, we add all these numbers up and we put it here. When we apply all of these changes, if this number here ends up being positive, then this means we provided cash. If this number ends up being negative, that means we used cash. So if this number is positive, that means our core businesses generated cash. If this number is negative, it shows that our core businesses used cash and didn't provide it. So ideally, you would want your company to have a positive number here because you want your day-to-day operations to be yielding you cash. Now, the other thing we mentioned in class was if this number is positive, net income, you have $1 million, that doesn't mean you necessarily have money in the bank. This could be $2 positive because of these adjustments. And these adjustments are primarily due to the accrual method of accounting, which says we record things when they happen, regardless of when the cash transaction took place. So the reason we have to do these analysis is because of the accrual method, and we have to adjust for the timing differences. Okay, so I hope that makes sense. I hope that answered your question, Alondra. And do go to Blackboard and download those. Great. Do download these, and then the recordings are here because I think those will help you as well. I'm not sure why it's not downloading for me right now. Okay, we have a couple more minutes. Any other questions? Okay, well, I guess we will call it a night, and I will see some of you in the morning and some of you on Tuesday. And hopefully all of you saw the emails from the university that everything seems to be working okay, and that the water is back on. So hopefully none of you lived on campus and had to deal with any major issues. So you have a great night, and I will post this recording probably in the morning after I get through editing it, so that you don't have to listen to blank space. Have a great night, and thank you for signing in.